Okay, picture this. Imagine a publicly traded financial company managing massive wealth, but they're doing it with a headcount of just 24 employees. Seriously, 24! That's literally less than the staff of your average local grocery store, right? Yet this tiny team is somehow moving mountains in the financial world.
Just 24 people are managing over $1.4 billion in assets, a billion with a B. And here's where it gets absolutely crazy. They're doing all of this with zero debt, none. Plus, they're handing out a massive 10% shareholder yield while they're at it.
Now, the real jaw-dropper here is the return on capital. We're talking a staggering 356%. I mean, a number like that would normally make value investors absolutely weep with joy, right? But there is a massive catch, one that Wall Street and the mainstream media completely ignore. Because underneath that shiny 356% metric, this company actually suffers from negative return on invested capital and has absolutely zero economic moat.
So today, we are tearing down U.S. Global Investors, ticker symbol GROW. We're doing a full forensic explainer to uncover these bizarre metrics that the financial press just totally misses. Is this a deep value hidden gem? Or is it a product factory disaster just waiting to happen? Let's figure it out.
Okay, so here's our game plan. We'll start with the microcap anomaly, dig into some pretty scary hidden red flags, flip over to the contrarian green flags, put it all through a face-off with legendary investing titans, and then, finally, we'll hit the final verdict.
All right, let's jump right into it. What exactly is U.S. Global Investors?
Well, they're led by the charismatic Frank Holmes, and they are basically a tiny, incredibly nimble asset manager. They specialize in highly specific, thematic ETFs. Think of them almost like a product factory. They've got their massive pandemic hit, the Jets Airline ETF, right alongside their rapidly growing War ETF, which tracks defense and AI, and then, of course, your traditional gold funds. So you see, they aren't trying to be the next Vanguard. They are specifically trying to capture these explosive, niche market themes. And honestly, on the surface, the momentum looks like a total slam dunk. Surging revenues of 31% year over year. They recently swung from a loss to a cool $2.7 million profit, and those War ETF assets, they're nearly doubling quarter over quarter. Sounds incredible, right? Almost too good to be true. But you know us, we need to look under the hood and check that structural foundation. Which brings us to the hidden red flags. These are the traps the mainstream media is completely walking right past. First up, their absolute dependency on JTS. Product concentration here is just extreme. They really lack real diversification. So what does that mean for us? It means if travel sentiment fades even a little, or if a competitor swoops in with a cheaper airline ETF, their core revenue engine just stalls out. Essentially, if the airline sector sneezes, GROW catches full-blown pneumonia.
And that leads to a really crucial point. GROW's moat is a total mirage. Just think about this contrast. They operate with $1.4 billion and zero switching costs, meaning investors can just dump their ETFs with a single mouse click. Meanwhile, you've got giants out there like WisdomTree managing well over $100 billion. So GROW is basically just a minnow swimming in a shark tank. They have zero durable competitive advantage to lock investors in. Being nimble is awesome, but guys, it's not a moat.
Then there's the shrinking safety net. Even though they have a pretty decent price-to-book ratio on paper, the underlying net asset value of the entire company is actually shrinking when you zoom out over a multi-year horizon. A negative 1.2% three-year book value growth? Yeah, that tells us the foundation is slowly, quietly eroding right out from under them.
But honestly, arguably the most alarming operational red flag popped up in June of 2026. Get this timeline. They reported earnings, discovered an accounting error, and then had to officially restate those earnings simply because, wait for it, they accidentally miscounted their own shares. Now, okay, it was only off by a penny or two, sure, but it signals a massive breakdown in internal controls. I mean, if a financial company can't even count its own shares accurately, you have to ask yourself, what else is slipping through the cracks?
Okay, let's shake off the doom and gloom for a second and flip the coin. What are the contrarian green flags? What's making the value investors actually drool over this thing? 0.00. That pristine number is their debt-to-equity ratio. GROW has an absolute fortress of a balance sheet with completely zero debt. Add in a current ratio of nearly 21 and a massive pile of cash, and you've got a company built like a bunker. In a rising rate environment or even a sudden market crash, this thing is built to survive.
Oh, and how about the fact that they're basically paying you double the yield of a 10-year treasury just to sit and wait? We're talking a 10% shareholder yield through monthly dividends and aggressive buybacks. That's huge. Plus, insiders already own 22% of the company. CEO Frank Holmes, he's buying shares with his own cash, and heavyweight institutions like Vanguard and Gator Capital are actively piling in. When the people running the show are backing up the truck at these prices, you've absolutely got a momentum story that demands attention.
And then, we circle back to that wild metric the media completely misses: return on capital. Since Grow is a hyper-efficient people business with almost zero physical assets, for every single dollar of capital they invest, they get an astounding $3.56 back in operating profit. That's a 356% ROC. Seeing that level of capital efficiency in the wild, it's practically unheard of.
So how do we make sense of all these paradoxes? It's time for the Investing Titans face-off. Let's put Grow on trial. First up to the plate, the father of value investing himself, Benjamin Graham. Now, he definitely finds the valuation metrics appealing. A PE of 12.1 and a price to book of 0.81, those absolutely check his boxes. But his final verdict? He'd call it borderline. Why? Because the stock price sits just a hair above his notoriously strict intrinsic value calculation. So he'd argue it lacks a true margin of safety. With a Graham number of 292 against the stock hovering around 298, it's just a bit too close for comfort. Close, but no cigar for Ben.
Next, we bring in growth legend Peter Lynch. Sure, initially, he might like the growing revenue and the negative PEG ratio, but he'd take one look at that wild 1,848% earnings spike, which, by the way, was derived from a previous loss, and he would tell you to run. His verdict is a clear, hard avoid. He'd instantly recognize this as a cyclical recovery trap rather than a genuine, sustainable growth story.
Okay, what about Warren Buffett? Well, the Oracle of Omaha would definitely praise that pristine debt-free balance sheet. We know he loves that. But his ultimate verdict? A hard pass. The reason is simple. Buffett absolutely despises severe product dependency, and he hates a total lack of pricing power even more. Seeing an ROE below 15% combined with absolutely zero economic moat? Yeah, that makes this totally uninvestable for him.
Ah, but Joel Greenblatt, he couldn't care less about moats. He cares about capital efficiency and price. His verdict? Utterly intrigued. Getting a 356% return on capital for just 12 times earnings? That is the exact, literal textbook definition of his famous magic formula. This stock hits his absolute sweet spot.
So, where does this brutal tug-of-war actually leave us? Let's get to the final verdict, the bull versus the bear. When we tally up the results, the divide is crystal clear. On one side, you have the massive bull case, a debt-free cash machine returning 10% to shareholders, riding these hot thematic waves with massive earnings leverage. But squared off directly against that is the bear case, a fragile product factory that could instantly collapse if defense spending cools off or gold corrects, with literally zero power to stop investors from jumping ship. So ultimately, the real question isn't whether this stock is cheap. It clearly is. The real question is, are you willing to bet on the next hot theme lasting long enough to build a real, durable business around it? So, what's your takeaway on this anomaly? Are you buying into the Greenblatt magic formula? Or is that missing moat keeping you far, far away? Dig into these metrics, read the filings yourself, and never stop questioning the numbers. Keep learning, guys. See you next time.